Welcome to Real Vision. It's Wednesday, October 28th, 2020, just after market close in New York. This is the Real Vision Daily Briefing. I'm Ash Bennington, joined shortly by Real Vision's managing editor, Ed Harrison. Ed, welcome back.
Yeah, I was going to say looking good, and you were supposed to say feeling good, but actually, no, we're not feeling good at all today.
Yeah, looking at U.S. equity markets, it's hard to feel good. So right off the bat, we've had a pretty ugly day. Numbers still bouncing around here a little bit at the close. We were filming just after market close, U.S. New York time. Dow off 3.4%, settling at 26,519. S&P off 3.53%, settling at 3271. And the NASDAQ off 3.73%. Barely holding the 11 handle, 11,004.
Yes, so very bad day. Actually, I think this is the fourth down day in a row. And, really, I think if you look at it from a macro perspective, it's all about the fact that in Europe, we were selling off already because of the coronavirus and restrictions and so forth. And then that selling continued into the US. And, these jitters have been going on now for 4 days. This is the fourth day in a row that we're down. So this is we're now at a point where we can say that this is a real event. This is a problem, and it's definitely getting worrisome.
Yeah, exactly. Just for a little bit of context around those numbers, S&P 500 closed last Friday at 3440. Here we are, close of day Wednesday, 3271. That's a change of minus 4.9%. Similar story on the NASDAQ, closing last Friday at 11,548, now at 11,004 for minus 4.7%.
Yeah, so I have to give a bit of a mea culpa here, Ash, because I was going to get my Dow 30,000 hat out, and I was ready for for us to be off to the races. Because you remember that I was saying September, October was the moment of truth in terms of understanding, the forward visibility, in terms of do we have acceleration for um, uh, continued recovery. And we had jitters about that at the beginning of September. We had a correction in the NASDAQ, and that went away. So by a week, 2 weeks ago, I was saying that it doesn't look like we're going to have any more jitters. I think that we've gotten out of this period, the September-October period, pretty well. And lo and behold, literally the last week, we're back to where we were before. So my whole thesis of September, October is back on the screen. Out of nowhere comes this whole dynamic of shutdowns in Europe. And that's really, for me, what's driving all of the volatility that we're seeing right now.
Well, Ed, I'm a great fan of your framework, and I always mentally extended October till at least November 3rd. I figured to the end of the election, that's really your time horizon.
Yeah, and I think that the Americans are doing a decent amount of navel gazing in terms of being totally focused in on what's happening in this historic presidential election. People are talking about a blue wave. Other people are talking about, the Senate going to the Republicans, et cetera. Really, I think the real story now is in Europe. I would say, however, just going back to what we were talking about on Monday, that yes, I think that there are scenarios in U.S. politics that aren't priced in.
Yeah.
For instance, a Trump win is not priced in. I don't think that the Senate staying with the Republicans is priced in, and that's going to have a meaningful impact. But I don't think that the lead up to November the 3rd, as we're seeing it now in this level of volatility, is as a result of anything that's going on in the United States. Really, what's happening is all about the situation in Europe and the fact that it's not just about the coronavirus cases. It's about the actual policy response, that is lockdowns, that they are having lockdowns. I'd like to use, just for the moment, just for today, I'd like to use Tony Greer's his narrative, which is that it's hysteria, that in the United States, as soon as November the 3rd is over, it's going to go away, the whole narrative in the United States. Let's just say that that's actually true. In Europe, the hysteria has created lockdowns. If you want to use it from Tony's perspective, and that's what's driving it. It's that the policy response, shutdowns, could potentially lead to a double dip recession, and that's very negative for risk assets. Could the same thing happen in the United States? Maybe, but we'll just have to take a look and see.
Yeah. We've been talking about this in some ways in kind of in four parts for a very long time. You have the actual events on the ground, you have the perception of the events on the ground, you have the economic impact, and then you have how various risk asset markets price the relative risks and potential rewards. And so it's a pretty complicated calculus, but yeah, that's spot on in terms of what's happening in Europe right now. Obviously, very much the center in terms of the news cycle, in terms of what's happening with COVID. Look, Germany is closing bars and restaurants right now. France is talking about potentially a 1 month lockdown. And when you look right here in the United States, and I think we can pull up the charts, first, the trends in the numbers, and this is data from CDC, the trends in the case data, if you look at not just the number of cases, but if you look at that critical 7-day moving average, you can see that what we're moving toward now is a fair third peak, and this is something that's pretty significant in terms of case count. Now, the following chart is an interesting one. This is COVID mortality, and what you've seen is an increase in the rate of mortality here in the U.S. from COVID, but as of yet, it hasn't yet approached the level of steepness of the curve that we're seeing in rising rates. Now, obviously, that's a good thing. If you look at those three peaks next to each other, what you can see is that the second peak is higher than the first. And while the number of deaths rises after the second peak in case count, it doesn't rise nearly to the same level. That suggests hopefully that we're getting better at treating it, that younger and healthier people are getting the disease, and that potentially, and we won't know this because we haven't sequenced the virus at that level yet. We'll figure this out as the months go by, but hopefully it means that it's mutating in a way that's making it less deadly. Those would all be potentially good things. But when you look at that chart, obviously the infection rate is a leading indicator ahead of the impact of the disease, which could unfortunately ultimately lead to mortality. So this is definitely something to watch closely. I just see, as I look out across the broad landscape of all of the things that are happening today, just a tremendous amount of risk, uncertainty, indeterminacy. Look, we're 6 days away from an extraordinarily tense election. As I said to Tony yesterday, the one thing that I know for sure is that if we do have an outcome, meaning if we do have a clear winner, that half of the country is going to be very unhappy about it.
Yeah, unfortunately, that is the case. But let me go back to something you were talking about with coronavirus, because I thought it was interesting. I was looking at a tweet from Christian Oldendahl, who's a European policymaker, and he says that people seem to think that lockdowns in Germany and France are similar. They're not. What he says, and I thought this was interesting, is that Germans are free to go anywhere. All businesses remain open except those for social consumption, private social gatherings, and just restricted. Travel is just discouraged. Tourism is banned. And his analysis is that at the end of the day, the difference between Germany and France is actually that France waited longer in order to lock down than the Germans. The Germans, even though it's coincident in time, the Germans haven't gotten up the curve in terms of the epidemic of cases and hospitalizations and deaths relative to the French. And so the French are actually imposing a much more stringent lockdown because they're forced to do so because they waited longer. And I think that, from the first wave, we know that the countries that locked down later, their public health outcomes were worse. And as a result, potentially they had to lock down more or suffer more deaths. That includes the United States, of course. That includes many countries in Europe. So when we're talking about this, I mean, a lot of this is speculation, but I want to make a clear forward-looking statement. You can timestamp it here. What's happening in Europe will happen in the United States, and what's happening in Europe will be delayed in the United States in the same way that there's a difference in delay between Germany and France. And the outcome is going to be more deaths. I'm saying that right now, so that there's no bones about it. I'm not talking about hysteria or rising case counts. I'm saying definitively we're going to have a tremendous epidemic level of deaths from COVID in this particular shutdown. That's my view. And I think that Christian Oldendahl makes that very plain. And just to sort of piggyback on that, I've been saying this actually for quite some time because a lot of this stuff is foreseeable in my view. So I wrote at the end of May when we were getting out of the first lockdown. This is what I said on credit write-downs. I said, I don't think full-scale lockdowns are politically viable anymore, given the massive private sector economic hit and government deficits they entail. I would go so far as to say they won't happen except in extremis, and that means the potential for epidemic levels of viral spread and death are possible in second, third, and fourth waves until we build some sort of herd immunity, probably through a vaccine. It may not happen at all. Actually, we're now finding out. And I said that I find it hard to believe that we're going to get a decent recovery given the downside risks and the policy and the viral fronts. I'm not saying can't happen, but the outline I just went through points to some of the challenges. And so I ended out saying this: if we are left blindsided by a second post-lockdown wave, which happened, by the way, or a third fall-winter coronavirus wave in the Northern Hemisphere, which is happening, by the way, and this is something I wrote in May, it's because we didn't prepare. The risks were there for all to see, and the deaths will have been preventable. Policy errors matter, and they cost lives. That's exactly what's happening right now. It was totally predictable. I said it 5 months ago, and it's happening just as we expect it to happen. So when I say that the death tolls will be higher, I'm making a forward-looking statement. I'm saying I see what's happening right now in the United States. And we are not just going to see cases rise. We're going to see hospitalizations and then deaths after that. And then the question becomes, what does that mean from the economic and the market perspective? And we can talk about that.
Yeah. That's a very powerful and sobering statement.
Yeah, I mean, as I said, it's not like I'm pulling this out randomly. These are comments that I made in verbatim five months ago. So the fact that it's playing out isn't because I'm a prescient in any way. It's because I was listening to the data. I was coalescing what they were saying and thinking about, given our policy responses in the past, what were likely to happen in the future. I think where the rubber hits the road in terms of our listeners is what does that mean for the markets? Because as you said, there's a whole configuration of things in terms of the Googles and the Facebooks, the COVID resistant stocks. How do they perform in a market slowdown? If the government doesn't lock down, what happens then? Does the economy still continue to take off? I mean, this is what I think is here's what I would say. I would say that full-scale lockdowns, they're not politically viable. That means that you're going to get these epidemic levels of viral spread before you do lockdown or if you lock down. And ultimately, that's because a couple of weeks delay in responding vigilantly to the coronavirus costs tens of thousands of lives. We've already seen that, and we're going to see it again. And so we've been hoping and praying all along that we wouldn't get to this worst case outcome. Europe has, and I'm predicting that the U.S. will. And I think that only after even worse public health outcomes in Europe will the U.S. have any sort of similar policy response. And my sense is that the tail risk of a double dip increases markedly as a result of that. So I think that consumers respond to epidemic levels of death counts. They're not responding now because we're not there, but when we get there, there will be a response and it will be very negative.
Yeah. Ed, one of the things that I've appreciated about your analysis from the beginning is how nuanced it is. One of the things that I find most disconcerting about the political place that we find ourselves in right now in the U.S. Is everything has become totally bifurcated. Everything is totally binary. You've seen a great deal of nuance. You've seen a great deal of difference in the precise mechanism of implementation around lockdown, how targeted they are, when they begin, what they cut off, what they don't cut off. You've been, I think, prescient as well with pointing out the idea of lockdown fatigue and how that sometimes locking down more tightly than is necessary can create a backlash that actually has the paradoxical opposite effect that it's intended to. So much of what we hear in traditional media is binary. It's, if you're in this political party, you're opposed to the lockdown, you think it's terrible. If you're in this political party, you want more of the lockdown. It's such a binary, bifurcated way of looking at the world, and it's infinitely more nuanced than that. And the reality is that kind of thinking, when it becomes a question of politics and not a question of data, the people who suffer are all of us. It's the entire country and it's the economy.
Yeah, and certainly from a markets perspective, we suffer if we let the politics lead us as opposed to the data. Speaking of which, let me just say that Pinterest came out today, beat earnings, they're up 20%. Ford came out, they beat earnings, they're up 5%. So this is on a day, this is after hours, a day where the markets were down 3.5 to almost 4% across the board. What it says is that people aren't throwing the baby out with the bathwater. There are actually companies that will outperform. So when you're thinking about this, if you want to put a paradigm on it, how to think about the volatility, I think that it's a stock picker's market. There are places to hide. I just mentioned two specifically for right now. Whether they have durable, long-lasting growth is another thing. But there's more ability at this particular juncture, more in particular for individual investors, retail investors, because they're not beholden to quarterly earnings in terms of how their company's doing. There's more ability to outperform. One thing that I would point out is that if you look at charts of, say, the U.S. 10-year Treasury, and you look at a S&P 500 chart, what you'll see is that we're nowhere near the levels on the U.S. Treasury that we were a month ago. A month ago, we were below 70, well below 70, somewhere around this 67 basis points level. Now we're at about 77 basis points, even after coming off from a high above 80 some. Yeah. The S&P is actually lower now today than it was a month ago. So what that says to me is if you're a 60-40 investor and you're investing through this level of choppiness, you're not going to be compensated in fixed income for the losses that you incur in equities. This is something that we've been talking about a lot on RV, is that when interest rates are really low, bonds fail to operate as a hedge against what's happening on the other parts of your portfolio. So you're going to take a lot more of the hit on equities, and we just have to hope that the hit is less. And then we have to decide, do we think the Fed's going to come in and pull the ripcord? And is that going to have any impact on what the eventual outcome is?
Yeah, when you're at whatever the low was, what was it, like 31 basis points on the 10 sometime in looks like March, there's just not a whole lot of room for price appreciation in that portfolio.
Yeah, so I think that what we'll see is that if we get more than just these past 4 days, we get like a February to March sort of action, then bonds are not going to help you as much as they did in the past, just because yields are as low as they are. And by the way, when I mentioned February to March, that time frame, I think if you think of it from an economic perspective, think of right now as being February. If you think about the first wave hitting the United States in the February timeframe, all the signs were there that that wave was going to come and it was going to crescendo. We were getting the coronavirus cases going up. There weren't as many tests there, so we didn't know. Now we know we have much more tests. I believe that we are going to see an exponential increase in hospitalizations and deaths, and then it's going to have an impact on markets. And then the question is what do policymakers do? From a federal perspective, I don't see any stimulus happening anytime soon. From a shutdown perspective in the United States, I don't see a shutdown happening on a national level anytime soon. Trump's already said, he's against those kinds of policies. So, it's going to be the Fed riding to the rescue, and then they'll do so against the backdrop of the insolvency phase of this particular cycle, the one that Raoul's been talking about. So that's where we are right now. from a macro paradigm perspective.
Yeah, and if the Fed comes running to the rescue, they're going to do so kicking and screaming and pointing fingers and asking for help from Congress, which doesn't seem to be forthcoming.
No, yeah, and I think if if you take a longer term view, the question is can the Fed stave off the insolvency phase enough to protect investors from the losses that bonds won't be able to protect them from. Meaning, is the Fed's intervention going to be enough in the way that it was in March? That's the big question that people are asking. Because, as you rightly state, the Fed's reactive. They're going to wait until the carnage is there. The carnage is already starting to pile up. How much further down do we need to go before the Fed intervenes? I would say a decent amount. But once they do intervene on the backside of that intervention, what does it look like? What does the economy look like? What do markets look like? My view, and I think that this is purely speculative at this point, is it looks worse than it did in the first wave in terms of the ability for risk assets, junk bonds, and equities to bounce back immediately. So it's looking more like this interregnum, this 6 month period, is much more of a head fake, and that potentially, we're going to see some more downside risk here.
Yeah, I hope it doesn't literally become an interregnum with a period between two kings in dispute. That's really the worst nightmare scenario coming out of November 3rd, and that's at this point not the most likely possibility when you look at the math, but it is a possibility that you could get either a totally deadlocked electoral college vote, or you could have too close to call in a number of key states that might delay the outcome. Now, that's not a base case scenario, but it was something that happened in 2000. And if you look at the polling data, especially the poll of poll data, it does appear that those races, many in those key swing states, are closing.
Yeah, I would say that that's a tradable event in the sense that, there might be volatility around that over the short to intermediate term, but it'll work itself out by January. If you're looking at it, it just depends on what your time horizon as a trader or investor is. If you're looking at it over a longer period of time, by the time we get to January the 20th, I'm fairly confident that we'll have it worked out. And then the question is, what does the real economy look like at that point in time, given the policy framework that we put into place? I think that the real downside risk, the real tail risk, is that things spiral out of control economically during that period enough such that just the intervention of the Fed won't be enough. There won't be enough fiscal, bankruptcies will start to pile up, commercial real estate will start to implode, things of that nature, and that you can't recover from that because it's too far gone. That's the real tail risk. I would say it's actually more than a tail risk. It's probably a reasonable worst case scenario at this point in time.
Yeah, I mean, the Department of Treasury coordinating with the House, obviously two different parties here. This is really sticky on the fiscal side to getting a political outcome. I think it was thought by many that we would get a deal. It didn't happen.
Yeah, and by the way, let's just say that there is a lot of volatility with regard to the election, and you're able to trade around that, and then come January the 20th, we have a government in place in the U.S. What if that government is a divided government, as it is today? That's a scenario in which the stimulus is not going to be able to be a safety basket. Again, it will mean that the Fed is on the hook for doing any and all things necessary to prevent worst case scenarios. So that's not a good scenario. So I think the quicker that we come to an understanding about what the configuration is, the more likely we are to be able to have an understanding of what it looks like. From a risk perspective, in terms of downside versus upside risk, I think the upside is probably in a scenario where the parties are the same. The biggest risk to the downside is where the parties are different and that there's some sort of gridlock, because that's a scenario in which the policy response in the US is going to be more limited. And given my view that we're going to see epidemic levels of coronavirus contagion and death, that's not a good recipe. That's not a good intersection.
Yeah, you talk about the Fed being kind of the ultimate backstop, the lender of last resort function, the backstop of last resort for the country. In many ways, if we remember Jerome Powell, when he came into office early on, basically said, "Hey, we're not going to do that kind of thing anymore. That's not what I'm here to do when I'm running the Fed." Reality on the ground said otherwise, and he had to make those difficult decisions, which ultimately look, frankly, a lot more like what we saw in the past than not like what we saw in the past. Meaning the Powell Fed looks a lot more like the Yellen Fed, I think, than Mr. Powell had anticipated.
Yeah. So, I mean, my last thoughts here for today are that you and I were probably thinking to a degree about what happens in 6 days. But I'm really more concerned about what happens in 6 weeks, specifically with regard to the coronavirus cases, how that transformation occurs. I believe we're on the cusp of, a major spike. We're on the cusp of something that is akin to, could potentially be worse than the first wave. Certainly in Europe, places like France, it can be and probably will be. Macron was saying that this is the case, worse. And then we just have to see what happens, what the policy response is. But at a minimum, consumers will react, and they will react negatively, and so that's considerable downside risk. I think a double dip is a foregone conclusion now in Europe. They're back to May 2020 levels, and the U.S. is next to consider over that 6 weeks that I'm talking about. So to be continued. Sorry that I'm the doom and gloomer here today, the way that you were on Monday, but that's how I see it.
Yeah, it just feels like there's a tremendous amount of risk, and the really staggering part when you look at Western democracies is just how poorly everyone has prepared for it. It's this feeling of like being in college and you get assigned a term paper at the beginning of the semester, and lo and behold, it's 3 days before it's due, and you haven't written it yet, and there's like this feeling of surprise, like this should have been entirely predictable. I had kind of a moment yesterday. I ran out from the apartment, ran down to the pharmacy on the corner, and on my block, what's that?
You got some hair dye and deodorant.
Yeah, they let me out occasionally to buy hair dye and deodorant, and I have a little like urgent care facility on my block, and I often go there for sore throat or whatever. And as I'm walking down the street going to the pharmacy, I see there's this enormous line of people. I don't know, 8, 10, 12 people stacked up 6 feet apart, standing out in front of the doctor's office, waiting to be seen for whatever was wrong with him. And you think about that here in New York City, if we get a second wave and the predictions and analysis that you've put forth comes true, you can imagine this when it's 22 degrees out and snowing, and you have people who are sick, and you've got additional seasonal flu, and you have people stacked up outside of doctors' offices waiting to get in. It's a pretty grim scenario.
Well, let me give you the silver lining. I didn't think about it before you talked about Western democracies, but one overlooked thing in all of this, honestly, is Asia, East Asia
Yeah.
in particular. East Asia is doing incredibly well relative to the rest of the world.
Yeah.
If the things that you and I are talking about are true, then eventually there's going to be a travel ban. They're going to ban us from going there. And we'll see how well their economies do under those circumstances. But if you had to take a relative value trade, it would be, long emerging markets, Eastern Asian emerging markets, short developed markets in Europe and North America.
Yeah, it does feel like the West, and that was why I pointed it out. Vis-a-vis Eastern Asia, there has been some incredible progress that some of those countries have made. Some of the largely smaller countries, Taiwan being an obvious example, South Korea, well-defined borders, island nations, easier to restrict travel. But nonetheless, it's hard to feel as though the U.S. and Western democracies in general are anything but laggards in this scenario.
Yeah. With that, I think we'll have to leave it on that sour note. But uh, bullish Asia, East Asia.
Well, let me just switch gears here real quick before we leave to talk about something that has held up rather well. Bitcoin up still over 13,000 despite the sell-offs in U.S. equity markets. It seems as though we've had something of an inverse correlation. It's off about 3.5% when you look at it over a 24-hour sliding window because the time horizons trade differently than U.S. equities. But the reality is that as U.S. equities have sold off, digital assets, especially Bitcoin, have managed to retain value and look like something of a safe haven trade.
Yeah, interesting because, when you were talking to Tony, both of you recognize that there's been no movement on the currency front. And that's very positive for Bitcoin because, but in the past, when we saw the strong dollar, Bitcoin, people were liquidating their positions in gold and Bitcoin because of the liquidity crisis. But,
Yeah.
Bitcoin is doing incredibly well. I think crypto is a play to watch for sure.
Yeah. By the way, talking of mea culpas, I have to issue my nerdiest mea culpa yet. I said yesterday that I owned a small amount of Bitcoin in my brokerage account through an exchange traded product. Not strictly true. It is OTCQX traded, so it's an ATS traded security registered with the SEC, but technically not exchange traded.
We got to get you into the coin. Rao, he's going to want to speak to you about that.
Yeah, it's funny. I got teased a little bit about the fact that I don't actually own the underlying crypto myself, and I don't control the keys. Interesting conversation, probably a longer conversation for another day.
Yeah. So for Friday, I'll make sure to ping Rao to make sure that he gives you a hard time about that.
Yeah, I hear we're doing something special on Friday.
Yeah. I hear that you're going live. Is that right?
That's the rumor. I guess we've committed to it now, so I guess it's going to happen.
Excellent. Good. I'm looking forward to it. So live on YouTube, Rao Powell, Ash Bennington, Friday. Be there or be square.
Live without a net. Thanks for joining us, Ed.
You bet. Good to talk to you.